Episode 1. The biggest economic crises in history, and what we learn from them. Throughout history, economic crises have shaped nations, toppled empires, and exposed the fragility of financial systems. Beneath the headlines and the numbers lie astonishing details that most people don't know. Today, we're diving into the untold stories and shocking lessons of the world's biggest economic disasters, including some you've likely never heard of. The Tulip Mania, 1634 to 1637. Let's start with the Tulip Mania in the Dutch Golden Age. You might know it as a speculative bubble, but did you know that during its peak, a single Semper Augustus tulip bulb sold for the equivalent of 10 years of a skilled craftsman's wages? That's like paying $100,000 for a flower today. The craze wasn't driven by gardening enthusiasts. It was a frenzy fueled by financial speculation. Contracts for tulip bulbs were being traded multiple times before the bulbs even bloomed, creating a market built entirely on promises. What's more shocking? When the market crashed in 1637, some people were left with debts they couldn't pay for flowers they never even touched. The Mississippi Bubble, 1716 to 1720. John Law, a Scottish economist, proposed a revolutionary idea to save France from financial ruin after the country was deeply in debt from the War of Spanish Succession. He convinced the French king, Louis XV, to back his speculative venture, the Mississippi Company. Law claimed that vast riches awaited in the Louisiana colony, with gold, silver, and endless natural resources waiting to be harvested. Shocking fact. Law issued paper money to fund the venture, believing that the value of paper currency could be based on speculation rather than physical gold reserves. This was one of the earliest experiments with fiat currency. As the stock price skyrocketed, an overwhelming public frenzy ensued. At its peak, shares of the Mississippi Company were valued at more than 100 times their original price. Even more shocking, wealthy French aristocrats were buying land in Louisiana sight unseen, believing they were becoming global magnates. But the land was largely undeveloped swamp, and by the time the bubble burst in 1720, the collapse led to one of the most famous financial crashes in history. Law had to flee France, and his experiment with paper money became a cautionary tale for future financial innovators. The South Sea Bubble, 1720. Fast forward to the South Sea Bubble in England. Here's a jaw-dropping fact. King George I himself was an investor in the South Sea Company, and his endorsement drove the stock price sky high. The company promised unimaginable profits from trade routes in South America, but they didn't actually control any trade. At the height of the bubble, the company's stock price rose by over 800%. Ordinary citizens sold their homes to invest. But here's the kicker. The bubble burst when people realized the company was based on lies, causing the stock to plummet and wiping out the life savings of thousands. The government was so implicated that new financial regulations were implemented, including what we now know as the concept of insider trading laws. The Panic of 1857. The Panic of 1857 was triggered by a bank failure that quickly spread throughout the United States, exacerbated by the worldwide economic slowdown and the sudden collapse of the SS Central America, a ship carrying 3 tons of gold. This caused the price of gold to spike dramatically, and many Americans began to withdraw their savings, triggering a banking panic. Mind-blowing fact. The U.S. economy was so tied to global markets that the financial crisis caused by a shipwreck in the Atlantic sent shockwaves across Europe and the Middle East. Even though the stock market had plummeted, European investors still rushed to buy U.S. bonds, leading to further volatility. What you might not know, the U.S. government, struggling to respond, introduced an early form of unemployment insurance to keep the public from spiraling into further poverty. But the real impact was on the global stage. The Panic of 1857 helped spur economic tensions that would eventually lead to the American Civil War. The South, heavily reliant on cotton exports, felt the sting of the global collapse, and the North's booming industrial economy was brought to its knees by the crisis. The Long Depression, 1873 to 1896. While we often hear about the Great Depression of the 20th century, the Long Depression was a far more prolonged and little-known period of global economic suffering. Beginning with the collapse of the Vienna Stock Exchange and spreading across Europe, the Great Panic of 1873 led to widespread bank failures and unemployment. Surprising fact. The U.S. stock market collapse of 1873 led to the first global financial depression in history. The railroad industry, which was booming at the time, faced a complete collapse. The market had been oversaturated with speculative investments in railroads that ultimately failed. More shocking details. During the Long Depression, the U.S. unemployment rate reached as high as 14%, a level not seen again until the Great Depression of the 1930s. Despite the economic downturn, this period saw major technological advancements, including the widespread adoption of the telephone and electricity, which began to reshape the global economy. Cultural change. The Depression also accelerated the rise of labor unions, as working-class Americans began to organize for better pay and conditions. Social unrest and the rise of political movements that called for reform became a direct result of the prolonged depression. The hyperinflation in Weimar Germany, 1921 to 1923. After World War I, Germany was crushed by reparations and a devastated economy. The Weimar Republic tried to print more money to pay off the debts, leading to a catastrophic spike in inflation. By 1923, the German mark was so worthless that people used it as wallpaper. Incredible fact. At the height of the hyperinflation, prices were doubling every few hours, and by the end of the crisis, a loaf of bread cost 200 billion marks. People would exchange wads of cash just to buy a single loaf of bread, and in some cases, people were paid in wheelbarrows of cash. What most people don't know. Children played with stacks of worthless money, using it as building blocks. Meanwhile, wealthy Germans tried to protect their assets by converting cash into tangible goods like gold, art, and land. This event would not only devastate the German middle class, but it would also contribute to the rise of Adolf Hitler and the Nazi Party. Political chaos. The hyperinflation crisis destabilized the Weimar government and made many citizens distrustful of the democratic system. As the economy tanked, extremist political movements gained support, setting the stage for the Nazi rise to power in the early 1930s. The Great Depression, 1929 to 1939. Now let's talk about the Great Depression. Everyone knows the stock market crash of 1929 was a turning point. But did you know that during the first day of the crash, the Dow Jones dropped by 12.8%, the largest single-day percentage decline in U.S. history at that time? Panic spread so quickly that brokers jumped from the windows of their offices in despair, leading to the grim nickname, Black Tuesday. But here's a lesser-known fact. Even before the crash, warning signs were everywhere. For example, income inequality was at an all-time high. The richest 1% controlled 40% of the nation's wealth. Sound familiar? It's eerily similar to economic conditions today. One fascinating outcome of the Great Depression was the rise of scrip money. Communities created their own currencies to keep local economies alive when national currencies failed. These emergency monies are a precursor to modern concepts like Bitcoin and blockchain. The oil crisis of the 1970s. The oil crisis of 1973 wasn't just about oil, it was about geopolitics. After the Yom Kippur War, Arab members of OPEC imposed an oil embargo on countries supporting Israel, including the US and the Netherlands. Oil prices quadrupled almost overnight. But here's the detail that's often overlooked. In the US, gas stations ration fuel by implementing an odd-even system. Drivers with license plates ending in odd numbers could buy gas on odd days, and even plates on even days. Can you imagine such restrictions today? The crisis also triggered some unexpected innovations. The rise of compact cars. Before the embargo, American cars were big and gas-guzzling. But the crisis pushed companies like Toyota and Honda to dominate the market with smaller, fuel-efficient cars. The Japanese asset price bubble, 1986 to 1991. In the late 1980s, Japan was riding high as the world's second-largest economy. Real estate and stock prices soared, particularly in cities like Tokyo, where land prices skyrocketed to absurd levels. Stunning fact, Tokyo's Imperial Palace was valued at more than the entire state of California at its peak. Speculators bought and sold real estate at inflated prices, and Japanese banks gave out increasingly risky loans. The Bank of Japan kept interest rates low to encourage borrowing, which created a speculative frenzy in both the stock market and the real estate market. What you didn't know: as the bubble collapsed in the early 1990s, real estate prices in Japan fell by 70%, and Japan entered its lost decade, which lasted much longer than expected. What's more incredible is that while Japan's economy stagnated, its technology sector, including companies like Sony and Toyota, continued to innovate and grow, leading to a paradox where Japan was both in crisis yet still technologically advanced. Curious fact: the bubble left lasting psychological scars on the Japanese population. Today, Many people in Japan still hold on to their real estate out of fear that property prices will never return to pre-bubble levels. The Asian financial crisis, 1997. Moving to the 1990s, we have the Asian financial crisis, a meltdown that began in Thailand and spread across Southeast Asia. Did you know that before the crash, Thailand's currency, the baht, was pegged to the US dollar, giving a false sense of stability? In just a few months, the Thai baht lost more than half its value. The contagion effect wiped out billions of dollars across the region, with South Korea, Indonesia, and Malaysia hit hardest. Shockingly, some countries lost up to 40% of their GDP in a single year. One little-known fact is how billionaire George Soros became a central figure. Soros was accused of short-selling currencies in the region, earning massive profits while economies crumbled, a tactic that earned him the nickname, the man who broke the Bank of England. The Russian financial crisis, 1998. In 1998, after years of economic instability, Russia defaulted on its debt and devalued the ruble. This crisis sent shockwaves throughout the country and its former Soviet territories, but also rippled through the global economy. Shocking detail: the devaluation was exacerbated by the Asian financial crisis of 1997, which affected many of Russia's trading partners. As the ruble collapsed, Russian citizens lost their savings, and many turned to bartering goods in place of using the now worthless currency. It's estimated that up to 40% of the population fell into poverty as a result. Even more fascinating, during this time, George Soros became embroiled in the situation, accused of betting against the ruble, making millions while many Russian citizens lost everything. His controversial actions are still debated today. The Argentine economic collapse, 1998 to 2002. In the late 1990s, Argentina's economy was booming, but it was a bubble built on unsustainable debt and a fixed exchange rate with the US dollar. As the economy began to falter, the government froze bank accounts, leading to widespread protests. Shocking fact: the government's decision to freeze bank accounts was so extreme that people were only allowed to withdraw a small amount of money each week. Meanwhile, in many areas of Argentina, people began using barter systems to survive, exchanging goods like meat, wine, and even tango lessons as a form of currency. Crisis innovation. In the absence of a functioning banking system, alternative forms of money sprang up. Patacons, a local form of currency, were issued in some provinces and became more trusted than the global financial crisis, 2008. The 2008 global financial crisis was triggered by subprime mortgages, loans given to people who couldn't afford them. But here's the truly shocking part: the financial products built on these bad loans were so complex that even the banks didn't fully understand them. Take the infamous CDO squared, a financial product so convoluted it was nicknamed the black box. These were essentially bets on bets on bets, creating a house of cards that toppled when mortgage defaults skyrocketed. And here's something that will blow your mind. During the crisis, the US Federal Reserve secretly loaned over $16 trillion to stabilize global financial institutions. This is more than the entire US GDP at the time, and most of it was done behind closed doors. The Indian demonetization, 2016. In 2016, the Indian government's sudden move to demonetize 501,000 rupee notes, which made up 86% of the country's currency, shocked the nation. What's crazy? People stood in line at ATMs for hours, even days, hoping to exchange their old bills for new ones, which caused massive disruptions to daily life. Small businesses that relied on cash payments were hit the hardest, and many citizens had their savings rendered useless overnight. Unexpected twist. While the government claimed it was a move to fight corruption and counterfeit money, critics argue that it caused significant harm to the country's poor, who had little access to banks. Surprisingly, the demonetization also led to a rise in digital payments and online transactions, accelerating India's shift toward a cashless economy. Global economic crisis due to the COVID-19 pandemic, 2020. The COVID-19 pandemic triggered an unprecedented global economic crisis starting in early 2020. Economies around the world were affected by lockdowns, travel restrictions, business closures, and supply chain disruptions. Global impact. The global economy shrank by more than 3% in 2020. Countries such as the US, India, and Brazil faced significant economic challenges, with millions losing their jobs and businesses closing or scaling down. Emerging economies were especially vulnerable to the drop in global trade and falling commodity prices. Extreme measures. To mitigate the economic impact, governments adopted unprecedented measures, such as stimulus packages, in some cases, trillions of dollars in direct aid to citizens and businesses, while central banks slashed interest rates to historic lows and ramped up asset buying programs. Long-term innovations and changes. The pandemic accelerated digitalization trends such as remote work, online shopping, and the use of digital payments. On the other hand, the human cost of the economic crisis was devastating, with millions losing their livelihoods and facing extreme poverty. The crisis also exposed vulnerabilities in interconnected economies and disparities in healthcare and social welfare systems. China's real estate crisis, 2021 to 2022. One of the most concerning events in recent years was the real estate crisis in China, which began to unfold in 2021 and reached its peak in 2022. The crisis was triggered by a combination of excessive debt from large real estate developers and a general cooling of the real estate market in the country. Domino effect. Giant companies such as Evergrande, one of China's largest real estate developers, began declaring bankruptcy due to their unpaid debts, which amounted to over $300 billion. This caused a loss of confidence in the entire real estate sector, affecting both home buyers and global investors. Global impact. The Chinese crisis affected international financial markets, as China is one of the world's largest economies and plays a significant role in global trade. The collapse of Evergrande and other developers in trouble led to a fall in housing prices, payment failures to suppliers, and unfulfilled promises of properties to millions of Chinese citizens. Political and social consequences. The real estate crisis also exacerbated social tensions in China, where the middle class had massively borrowed to invest in properties. As citizens began protesting over undelivered homes, the Chinese government intervened with measures such as interest rate cuts and stimulus programs to prevent a broader economic collapse. Global energy crisis, 2021 to 2022. From the end of 2021 through 2022, the world faced a significant energy crisis, driven by soaring energy prices and a shortage of natural gas and oil supplies. Several factors contributed to this phenomenon. Key factors: increased demand for energy as economies recovered from the pandemic, combined with supply issues like a decline in natural gas production in Europe and rising oil prices, caused energy costs to skyrocket. Economic impact. Natural gas prices in Europe and oil prices globally hit historical highs. The cost of electricity surged in many countries, leading to energy inflation that impacted both consumers and businesses. In countries like the UK and Germany, household energy costs multiplied several times. Additional causes. The war in Ukraine, which began in February 2022, further intensified the energy crisis, as Russia, one of Europe's main gas and oil suppliers, cut its exports in retaliation for Western sanctions. This worsened supply shortages in Europe and beyond. Long-term solutions. The crisis also accelerated efforts to transition to cleaner and renewable energy sources, such as solar, wind, and nuclear power, though the path remains challenging due to the necessary investment and infrastructure. Cost of living crisis, 2022 to 2023. As the world recovered from the COVID-19 pandemic, global inflation began to rise, leading to a cost of living crisis in many parts of the world. The prices of food, fuel, and other essential goods increased to unprecedented levels, impacting families across all economic levels. Crisis causes. The global inflation was driven by multiple factors, including rising energy prices, supply chain issues, the war in Ukraine, and the long-term effects of the expansive monetary policies adopted during the pandemic. Social and political effects. In many countries, wages failed to keep pace with inflation, leading to a growing gap between the rich and the poor. Mass protests erupted in several places, such as Sri Lanka, Lebanon, and Pakistan, where people took to the streets due to rising poverty and a lack of access to basic products. Facing the crisis, many governments were forced to intervene with fuel subsidies, interest rate adjustments, and fiscal policies to try to mitigate the effects of rising prices. Banking crisis in the US and Europe, 2023. In 2023, several major financial institutions, such as Silicon Valley Bank, SVB, in the US, faced serious difficulties, leading to a banking crisis. SVB was the largest U.S. bank collapse since the Great Depression. Causes. The collapse was due to a combination of poor risk management and a massive deposit flight from clients who withdrew their funds due to a drop in bond investments. The bank's lack of liquidity caused panic, affecting other financial institutions and creating a loss of confidence in the banking system. Lessons learned. The collapse of SVB, along with other banking issues in Europe, highlighted the importance of financial regulation and the need for stricter risk management strategies to prevent future breakdowns. Lessons and innovation. Each crisis teaches us hard lessons. The Great Depression gave us social security. The 1970s oil crisis drove the push for renewable energy. The 2008 crash birthed Bitcoin, a decentralized currency designed to avoid traditional banking failures. But there's another lesson here. History repeats itself. Every bubble is built on the same human impulses: greed, fear, and the belief that this time is different. Understanding these patterns is the key to navigating the next crisis. In the next episode, we'll dive into the future of economics and explore how artificial intelligence is transforming markets in ways we never imagined. But for now, remember this: crises are inevitable, but how we respond to them defines us. Stay tuned. And don't forget to subscribe for more stories that uncover the hidden truths of our financial world.